Hi everyone, so this week we're going to do the only problem for chapter 3. I'm doing the A version of your homework assignment and you can find it on Cengage as the ungraded YouTube video problem for this chapter. And in this chapter we're going to do the statement of cash flow. So we're going to return back to that from way back when, the first couple of weeks of the semester when we introduced financial statements. So just as a quick review, the statement of cash flows the whole purpose of the statement of cash flows is to reconcile the impacts to the cash account on the cash account during the accounting cycle. All of our other financial statements are using accrual basis accounting. The statement of cash flows, we're going to kind of convert that back over so we can look at the impacts on the cash accounts during the period. As such, it's got 3 sections. I'm going to put CF, so CF from operations. So that's our revenue and expense transactions. We're going to have cash flows from investment activities, and that's buying and purchasing plant assets. And then we're going to have cash flows from financing. And that is like issuing stock and bonds, okay? Then the other things we're going to have on here is we're going to look at the cash basis at the beginning of the year and the cash basis at the end of the year. So when we get to the bottom of the statement, the adjusted cash balance for December 31st should be the same balance that we're using on the financial statements for the balance sheet. Okay. So you'll want to print this up, but one of the things you'll see in your homework assignment is it's going to give you some comparative balances from the current year and the previous year. In addition, they give us information on the land account, buildings, accumulated depreciation, equipment, bonds payable, common stock, paid in capital of excess of par, and retained earnings. So you want to look at those as we go. We are using the indirect method of doing the statement of cash flows. And so the first thing we're going to start with is cash flows from or used for operating activities. So we've got cash flows from or used for operating activities. We're going to do that cash flows from operations first. So the first thing we're going to start with is we either have to set up with a net income or a net loss. So where you want to go is you want to go to the returned earnings statement in your homework, the retained earnings ledger account. And if you look on the retained earnings ledger account, what you're going to see is on December 31st, they show a net loss. So on from the retained earnings, just so you know as you're going through, you can see there was a net loss that they posted on 12/31, and the net loss amount was $35,320. And you'll see that on the bottom line. So what we do with this statement of cash flows is we start with the net income or net loss, and then we go through and look at all the cash basis items that have impacted the statement of cash flows. So that's the first item, and we're going to have net loss on the first line. I'm going to put it on the right here on the inner column. $35,320. So then we're going to look at operating items, so revenue and expense items that have impacted the net loss account. So we're going to look, so the next one is adjustments to reconcile net cash flows from operating activities. So let me put that up here. So it's adjustments to reconcile net loss to net cash flow from, and it's operating activities for you, but I'm going to put operations because I'm going to run out of space here. So I'm going to put that there. So the first thing that comes up there that we're going to adjust is we're going to make an adjustment for depreciation. And the reason we're going to make the adjustment for depreciation, because depreciation expense was part of determining net loss, right? And remember, expenses are subtracted from revenues to come to net loss. Depreciation is a non-cash expense, so that's something we're going to add back in. And to calculate out the full amount of depreciation, if you look at, so I'm going to go here, if you look at the accumulated, so I'm going to put depreciation. So first I'm going to look at the accumulated depreciation account for the buildings, because that tells me how much interest expense was taken on the buildings this time. I can see the amount is $26,280. And I'm going to add to that the accumulated depreciation for equipment. So again, I'm looking at the ledger accounts here. So I'm going to add those two together. That's $29,340. And so the total depreciation expense that was taken this year was $55,620. So I'm going to put here, this is ledger accounts, and this was from the ledger. So now I'm going to add that non-cash expense back in. So I'm going to put that into our statement of cash flows as a positive amount. So that's $55,620. So I'm going to add that back in. The next thing I'm going to look at to take into account and add back in is a loss on the sale of land. You're like, well, where do I find this information at? So in order to go find that, you're going to go to the ledger account again. You're going to go to the ledger account for land. And if you're looking at that ledger account, it says on it, acquired cash, on April 20th, acquired for cash of $561,600. I'm looking at the wrong count. Sorry. For land, it says realized $151,200 cash from the sale. And it also shows that they credited the land account for $163,800. So you can see on 4/20, is that 4/20? Yeah, April 20th, they had a credit of $163,800. So this is the amount that the land was actually recorded at, that cost. They told us that they realized, so they received cash, paid for it, of a total of $151,200. So basically the book value of this cash for the land was $163,800. We received $151,200, which resulted in a loss on the sale of $12,600. So this is on the statement of cash flows, is where you kind of have to do some detective work. This is a non-cash loss, so this $12,600 is going to be added back. We're going to take $12,600 and we're going to add that in to our sale, loss on the sale of land. The next subheading we're going to look at to changes in current operating assets and liabilities. So I'm going to have changes. Current assets and liabilities. And that's going to be during the accounting cycle. We're going to look at accounts receivable, inventories, prepaid expenses, and accounts payable. So the first item we're going to look at is we're going to look at accounts receivable. And this, I'm going to take the information that they give us at the start of the chapter, the comparative balance sheet. So let me put, all right, so what they show us is they tell us that the current balance in accounts receivable is $828,900. And that's for, let's do Y2. And the balance in year 1 was $761,940. And you subtract these two. So that's going to show that we had an increase in accounts receivable of $66,960. Okay. This is important because what it means is that the sales that are included in with this net loss, they weren't all cash sales. $66,960 of those sales were on account, so we haven't received the cash for that. So remember, we're reconciling the balance sheet from accrual basis accounting to the cash basis. So we're going to take this increase in accounts receivables, and we're going to subtract that from the net loss based on accrual basis accounting. So that's $66,960. So remember, if we'd had a decrease in accounts receivable, that would have been more cash that we would receive. So then we would have added that in. But since these sales that went towards this net loss, 66,960 of them were on account and not on credit. So that's why we're going to subtract that. So that's the first item that we look at. We're also going to look at inventories, again from the balance sheet. So we're going to look at inventory. And in year 2, we have a balance of $1,268,460. That's year 2. We're going to subtract from that the balance in year 1, which was $1,162,980. That's from year 1. So this is going to give us, what we're going to see is an increase in our inventories of $105,480 increase in inventory. Okay, so we spent money on this inventory that we didn't sell in the current year. If we actually had a decrease in our inventory accounts from year 1 to year 2, we would be adding that decrease in. But since it's an increase, we're going to subtract that out as well. So we're going to put increase in inventories. And just remember, this is the indirect method that we're using. It's $105,480. So we've got 2 more items in here that we're going to look at because accounts receivable, inventories, and then the last of our current assets is our prepaid expenses. So we're going to go back over here and we're going to look at our prepaids. We're going to do the same process again. So the prepaid balance in year 2 is $29,340. That's Y2. I'm going to go this way just so that I have some more space on here. In the previous year, it was $35,100. So we're going to see that's going to be a decrease. And it's going to be a decrease of $5,760. Okay, so we used some of our prepaid expenses in earning the net loss from the year, but those prepaids, that's not a cash expense, so we're actually going to add those back in, that $5,760. So we've got a decrease in our prepaids of $5,760. Because if you go back here, so let's say in December we used prepaid insurance, remember that we would have debited insurance expense, and then we would have credited prepaid insurance. So that amount, there was no cash when we would have made that adjusting entry. And so since we're trying to reconcile this accrual basis net loss to cash basis, we want to add in those prepaids because we paid the cash in the previous year. And then the last one of our current, the last and the only current liability we have is accounts payable. So again, off that balance sheet, we're going to go with accounts payable. And in year one, we had, year two, we had account balances of $922,500. It's year two. We're going to subtract from that the balance in year one, which was $958,320. That's going to give us a decrease in accounts payable of $35,820. All right, so that means that we paid some items on account. We didn't pay out cash from that. So that amount we are going to subtract from our accrual basis net loss. So decrease in accounts payable. And that amount we're going to take out, $35,820. And if you get confused while you're doing your problem, there's a really good exhibit that shows how you add or subtract things when doing this statement, the cash flows from operating activities using the indirect method. So those are all the items that we have. And so now we can, once we subtract and add everything back in, what we're going to find is that we have a net cash flow used for operating activities. So we're going to end up with a net cash flow used for operating. And we're going to end up with a negative amount. So that's why it's cash flow used as opposed to cash flow from. So we end up with a negative amount here of $169,600. And it might not be appropriate for me to say that's a negative amount. It just means that we used more cash for operating activities than we earned from our operations. So now we can do the next item, and that's the next session, which is cash flows from or used for investing activities. For our investing. And before we get into this, I'm going to pause to put up a fresh sheet of scratch. All right, the next section we're going to do is our cash flows used for or from investing activities. Remember, that's from buying and selling property, plant, and equipment. So we want to look at the ledger accounts for those items. So the first thing I'm going to look at, and I'm going to put a ledger account here. So I'm going to go back to land. And in the land account where they recorded that sale, they also said they realized $151,200 in cash from the sale. So we have $151,200 cash from sale. That's cash that was supplied. So we're going to add that in here. We're going to put that cash received from land sold. that was cash that came into the company. So we're gonna add that in, 151,200. And the next item we're gonna look at is the building account. So if we go and look at the building account, on April 20th, it says they acquired the building for cash for 561,600. So building used $561,600 cash to buy. So again, that's going to be an amount that we used. So on the statement of cash flows, we're going to put cash paid for acquisition of building. That's an outflow of cash, so we're going to put that in parentheses. So that was the $561,600. And then the last ledger account we're gonna wanna look at is the equipment ledger account. And that tells us on August 11th, where on August 11th, we purchased for cash equipment for $104,400. So if we're looking at equipment, we used $104,400 cash to buy. So you'll see above that, don't get confused when you look at the equipment account, because on January 26th, they wrote off equipment that didn't have any value. That does not impact the statement of cash flows there. So now we've got cash paid for acquisition. So that amount, again, we use the cash, so that goes in parentheses because that's cash used. And so we can calculate out the full net cash flow used from investing activities. So that's going to come all the way out to the far corner, and that's a use in cash of $514,800. And now we can move on to the final section, is cash flows from or used for financing activities. And remember, these kind of activities are from issuing bonds, dividends, items like that. So we're going to want to look at, we're done with all of our asset accounts. And the next account we want to look at is the bonds payable account. And if we look at that account, it shows that we issued on May 1st, 20-year bonds for $270,000. So that's going to be an influx. So again, I'm going to look at our bonds payable account. Which one am I looking at? Bonds payable. And it shows that we issued $270,000. Issued $270,000 of bonds. When we issue bonds, we receive cash. So we're going to put that. That's cash received from issuance of bond payables. So that's brought cash in. So we're going to enter that in as a positive amount. And then we also need to look at the cash received from common stock. So if you look at the common stock account and then at the additional paid in capital, if you look at common stock, remember, we're just looking at transactions that have taken place during this current period. The common stock says that they issued 8,000 shares of common stock for $50 per share. So they show 200,000 from stock issue. But remember, they also have the additional paid in capital account for common stock. And then from that same transaction, we see that there was an additional $200,000 that were raised from the stock issue. So issuing this stock resulted in an additional $400,000 of cash coming in. So our next item on the statement of cash flows is going to be cash received from issuance of common stock. So that's an increase of $400,000. And then if we take a look at the rest of our accounts, we can also see if we're taking a look. Let me find the account here. If we look at the retained earning accounts, we can see that cash dividends were paid. So again, we're going to look at retained earnings. And it shows there that there were $32,400 cash dividends paid. Probably not the best move when we have a net loss of $35,320, but regardless, we paid cash paid for dividends. That amount was $32,400. Sorry, that's a 4. All right. So we're going to have cash flow from, I should put net cash flow from from financing activities. Oops. That's why I like it so much better when we're in class and you guys can catch me right when I make my problem. We already did investing above. So we have net cash flows from financing activities that come to $637,600. Okay, so then what we're going to do is we're going to take the difference from these to give us the net decrease in cash we're going to have this year. All right, so you're going to see we used for operating $169,000 and investing $514,800. We brought in $637,000 in cash from financing activities. So we're going to have a net decrease of $46,800. And we've got 2 more items that we want to put here. But first I want to take a moment, okay? So if you're an investor and you're looking at this, you would like to see the majority of cash flow coming from operating activities. And you can see here that once we reconcile everything to cash basis accounting, that we really used a lot of cash this year. And if we're looking at it, you know, the depreciation and the loss on the sale of land would have more than covered this net loss here. But it's because we increased the number of credit sales, we purchased extra inventory, and we purchased items for credit. That really helped with this net cash flow used. Investing activities, you know, if the company's growing, that's fine. We see they've invested in building and equipment. But what you don't want to see over a prolonged period of time is that the cash is being funded through investing activities, because the company needs to be able to be profitable and pay its bills based on operations rather than based upon selling stock or issuing stock, basically borrowing money or ownership of stock. All right, so then the last 2 lines are, we're going to go to, the next line is cash balance January 1st. So I'm going to put January 1st. So if you look at that, if you look at the cash balance, 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 if you look the comparative balance sheets, they tell us that cash on the first was $964,800. Okay, and so when we take the net decrease in cash, we subtract it from the cash previous on January 1st. We get a balance on December 31st of $918,000, and that's our cash balance. December 31st, which is the amount that we would include in on the balance sheet as we see in the comparative balance sheets. And that's how you do an indirect statement of cash flows.